calendars. Great. So good afternoon, everyone. Welcome to this meeting. We have a really robust agenda for today. Craig, can you pull up the slide deck? We are being recorded. So by remaining on the call, you consent to being recorded. Next slide, please. Okay, so we have a new topic for presentation discussion. We're going to talk about the financial status of private passenger auto insurers in the state, and my colleague Lynn Beckner, who's the Associate Commissioner for Financial Regulation, is going to lead that overview for us. We're also going to talk about a couple of states, or I'd say a handful of states, have laws on the books that look at excess profits and sort of examination by insurance departments and what happens if excess profits are found. And so we'll talk through some state laws on that a little bit. And then we're going to have a discussion to, I think, take the temperature, get some feedback from work group members on some of the things that we've heard, options we've heard, what you think makes sense, what you think doesn't make sense and why, and what you think we need more information about. So again, no conclusions here. I think we're really just hoping to start and have a free-flowing conversation so that we can start working on our report. And we should also talk too about if there are issues that we think need longer term study. I would like to start having that conversation today as well. And then if time permits, and it has the past several meetings, we'll hear questions and comments from the public. Any questions or comments from our work group members before we get started? Okay, next slide. Okay, I'm going to turn it over to you, Lynn.
Thank you, Marie. There were 143 insurance companies writing private passenger auto in Maryland in 2024. In this presentation, these insurers are referred to as the PPA insurers. The financial results of the PPA insurers are shown on an aggregate basis. I'll move quickly through the first few slides and focus on the last two slides that show Maryland-only business. The first slide depicts an upward trend in private passenger auto written premium in Maryland from $4.2 billion in 2015 to $7.2 billion in 2024. Next slide. The top four groups writing PPA nationally are State Farm, Progressive, Geico, and Allstate. These groups accounted for 57% of the total U.S. industry market and 66% of the Maryland PPA market by direct written premium in 2024. In Maryland, these four groups, along with USAA, Erie, Nationwide, Travelers, and Liberty Mutual, made up 92% of the PPA market in 2024. Next slide. AM Best revised its outlook for the U.S. personal auto segment from negative to stable in November 2024. An AM Best market segment report dated September 15, 2025, summarized the challenges faced by personal auto insurers, which included volatile loss severity, increased costs, an overall inflationary environment, and supply chain and labor market disruptions. These challenges resulted in significant underwriting losses for the industry over the past few years. AM Best stated, however, that due to carriers implementing rate increases and maintaining underwriting discipline, the U.S. personal auto insurance industry was able to turn an underwriting profit for the first time in 4 years. Next slide. This slide presents the underwriting results for the PPA insurers on a nationwide basis, including all lines. Given the business written by the largest PPA insurers is predominantly auto-based, these results align with the industry challenges detailed by AM Best. Similar to the overall U.S. market, they experienced underwriting losses, shown in red, between 2021 and 23. And in 2024 was the first underwriting profit for these companies in 4 years. Next slide. The combined ratio is a key measure of underwriting profitability. The loss ratio and the expense ratio are added together to get the combined ratio. A combined ratio over 100% indicates an underwriting loss. For example, a combined ratio of 105% means the insurer lost 5 cents for every dollar of premiums collected. Next slide. Underwriting results in the subsequent slides are from the state page of the insurance company's annual financial statements. The state page excludes administrative expense, and therefore this amount has been allocated to the PPA lines based on written premium. In addition, the loss adjustment expense is lower than the actual amount incurred, as the state page excludes loss adjustment expense related to general overhead for claims settlement. Nonetheless, these results are a reasonable estimate of actual underwriting results. Next slide. This slide shows the underwriting results reported by the PPA insurers in all states in the private passenger auto line of business. The combined ratio is shown toward the bottom of the financial chart. Over the 10-year period, excluding 2020, the combined ratio trended near 100%. 2020 was an outlier with a significantly lower combined ratio due to the COVID-19 pandemic with fewer people driving. In 2024, the PPA insurers reported an underwriting gain for the first time in 3 years. Next slide. Focusing only on Maryland, this slide displays the underwriting gain or loss for PPA insurers' private passenger auto line. The PPA insurers reported an underwriting loss in 2016 and 2022, as shown in the red font in the middle of the financial chart. The combined ratio toward the bottom of the chart shows an 89% ratio in 2024. This relatively low combined ratio was due to rate increases taken in 2023 and 24 in reaction to poor underwriting results in 2022. Loss and loss ratio results demonstrate losses rather than expenses were the primary determinant of underwriting profitability because the expense ratio remained fairly consistent throughout the period. Dividends paid to policyholders located at the bottom of the chart were higher in 2020 compared to other years. This may be due in part to refunds that were mandated or recommended by state insurance regulators. The MIA issued several bulletins in 2020 and 2021 encouraging insurers to make reasonable accommodations regarding premiums. Next slide. This chart depicts the combined ratio trend in Maryland from 2015 to 2024. The 100% combined ratio threshold is marked by the green line. Any ratio exceeding 100% indicates an underwriting loss. The overall trend is highlighted by the dashed line. 2020 was an outlier with a combined ratio of 78%. 2024 was the most profitable underwriting year in a decade, other than 2020. Excluding 2020, over the 10-year period, the combined ratio was near 100%, and for 2022, it was over 100%, indicating modest underwriting profits over the period. And so that's all that I have for this section. Does anyone have any questions?
Hey, Lynn, can you go back to or Craig, can you go back to the previous slide for Lynn? Yeah, I just wanted to highlight, Lynn, or re-highlight the big gain we see here in 2020, and then the comparatively minimal gains industry-wide, 22 and 23, and maybe a return to profitability in 24. And we saw pretty steady rate increases throughout that period. Is that a fair layperson's description?
Yes. Yeah.
Okay, great. Marceline, go ahead.
Yeah, just a question. I know you mentioned that there was guidance from MIA during the pandemic, suggesting that companies make adjustments. I know some states actually asked companies to remand or, kind of provide support to drivers because they weren't driving as much. Do you know in Maryland what companies took action, and if so, to what extent, or if any did, from the
I
guidance?
I think we would need to get back to you on that, to the extent that we have that data.
Okay, great. I'd love to know just what actions which companies took and to what extent. That would be great.
Okay.
Will, Marcelina will draw your attention to the substantial dividend
Yeah,
there in 2020. Yeah.
great. That's what I was wondering.
Yep.
Great.
Any other questions for Lynn?
Uh,
Go ahead, Nancy.
when you're saying dividends to policyholders, are you talking about mutual companies or to stockholders?
To policyholders.
Thank you. So the mutual companies. Thank you.
Mhm. Well, mutual companies and stock companies both pay dividends to policyholders.
Any other questions? Okay, I think we can move on. All right, so just a little bit of background about why we're looking at some of these particular metrics as part of this study. So in general, in insurance regulation, we at the MIA enforce laws that establish minimum surplus requirements for PNC insurers. And in fact, what we're accredited on is usually to make sure companies stay solvent, right? So we want to make sure that they have the resources to pay out the benefits under the contract. And PNC insurers generally have discretion under Maryland law as to how much additional surplus they wish to carry. And there might be good reason for that, right? One really important reason that an insurer may build additional surplus is to ensure its ability to pay out claims without risking financial stability if it experiences significant future losses or a catastrophic event. And I think, again, if I were to sum up in my layperson's view of the information Lynn just shared with us, it is really that private passenger auto can be somewhat volatile year to year, and there's a lot that goes on underneath the surface and that contributes to gains or losses in a particular year. So there was a bill, HB 1159, that didn't move out of committee this year, but it sought to address excess profits in the PNC arena pretty broadly. It proposed a uniform approach to determining the realization of and requiring the return of excess profits by insurers writing in any line of PNC insurance, and it would have focused on an insurer's premium revenue and incurred claim costs in a single year without considering an insurer's overall financial condition or the extent to which gains in one year may have been offset by losses in a preceding or subsequent year. And so it would have defined a PNC insurer's loss ratio as incurred claims divided by premium revenue. It would have established a minimum acceptable loss ratio of 85% for a PNC insurer, which is, by the way, generally what we do in healthcare, but they are different businesses with different puts and takes. It would have required that a PNC insurer issue rebates to its insureds if its loss ratio was less than 85%, and it established a formula for the amount of the rebate due. Next slide. So I think we submitted some considerations to the House Economic Matters Committee ahead of the bill hearing on this bill, and that included the following. Again, some P&C insurance policies have a really long tail, and so these insurers tend to have a higher surplus compared to other types of businesses because we want them to be able to pay out claims many years later. Certain lines of P&C insurance are less profitable than others. There is no exception in the bill for insurers that are in a hazardous financial condition or have suffered significant losses, right? In those cases, if we want folks to be building up a surplus, you may want I don't want to say loss ratio in the P&C context, but for a lack of better word, a loss ratio. You may want a lower loss ratio so that an insurer can build up that reserve again. And then the bill could have had adverse impacts on the net worth of P&C insurers and limit the ability to pay dividends. So recognizing that there could be benefit to targeted evaluation of some of the concerns that the bill sought to address, a look at this issue was given to us in this work group. And so that's why we're reviewing some of this data. And I think the next several slides will go into this is not a new or unique issue. Some states do have processes for evaluating what they call excess profits in the P&C world. And we're going to go through some of those examples now. Next slide. So this is Florida's example. So in Florida, each auto insurer group has to file prior to July 1 data on calendar year total limits, accident year incurred losses and loss adjustment expenses. Administrative and selling expenses incurred in Florida are allocated to Florida for the calendar year, and policy dividends. And then there's an underwriting gain or loss calculated. And then next slide. And then Florida law defines excessive profit if there has been an underwriting gain for the 3 most recent calendar accident years combined, which is greater than the anticipated underwriting profit plus 5% of earned premiums for those calendar accident years. If the insurer group has realized an excessive profit, the Florida Insurance Department has to order a return of the excessive amounts after affording the opportunity for a hearing. And there's a standard of review there. And the profit has to be returned in the form of a cash refund or a credit towards renewal policies. So it's an interesting formula. I don't know if Nancy or Marceline or Al, you have any background on how that was developed, or Katie for my team, but each of the states we're about to cover does this a little bit differently. So
that law's been on the book for some time, Commissioner. We had thought maybe that was part of the tort reform, but it wasn't. This was on the books for a long period of time. So I'm not too sure exactly when it was established, but we had assumed, oh, this must be part of tort reform, but it wasn't. So
gotcha. Thanks, Nancy. Okay, next slide. I believe this is a law that's been on the books for a long time in New Jersey, is my understanding, and Nancy is nodding. But in New Jersey, each insurer has to file with their insurance commissioner on or before July 1 a profits report relating to private passenger auto. And just for context, New Jersey does have some of the highest, if not the highest, auto insurance costs in the nation. Again, similar to Maryland, but even more densely populated, and a lot of different dynamics in that market. So each insurance holding company has to file a separate combined profits report for all insurance insurers in its system. It has to contain the information and calculations set forth in statute, and then the commissioner further defines that through regulation. And it has to include a bunch of information for the 9 most recent calendar accident years. Next slide. All right, so the excess profit report also has to include calculations for underwriting income, actuarial gain, and actual investment income for each of the 7 calendar accident years immediately preceding the date of the profit report, development adjustment for the 11th through the 8th calendar accident years immediately preceding the date, monies spent and monies encumbered to fund reinvestments by the insurer in the New Jersey private passenger auto insurance market, and total actuarial gain and excess profit. And then there's prescribed calculations for the 7 calendar accident years immediately preceding the date before the report. And an excess profit shall be deemed to exist when insurers' total actuarial gain for all coverages combined exceeds 2.5% of earned premium or 3.85 on a pre-tax basis using the federal corporate tax rate of 35%. So, woo, I think long story short, a little bit of a different formula than Florida, longer look back than Florida. Next slide. So here's a little bit more about New Jersey. Insurers that do trigger that excess profit formula have to establish, subject to the approval of the commissioner, a fair, practicable, and non-discriminatory plan for the refund or credit of excess profits to policyholders as the commissioner may determine to be reasonable. And in the event that profit is returned and then it's determined that maybe it didn't exist or was overstated, there's the ability for an excess profit carry forward. Next slide. Okay. So New York does this a little differently. So in New York, they look at profitability in the state relative to net worth averaged over a 6-year period. And they look at all sources of the insurer's income, including capital gains, investment income, and underwriting income. And they establish a base of several years to minimize volatility. And they define excess profits as the amount by which the 6-year average of an insurer's annual rates of return on net worth exceeds 21%. And they primarily do that review by looking at the financial statements and rate filings. There may also be further examinations and requiring insurers to file additional information. So I think our understanding is it's not as prescribed a process as there's a lot more discretion for the insurance commissioner there, maybe compared to Florida or New Jersey. The New York Department of Financial Services, that's their banking and insurance regulator, determines on an annual basis the amount of excess profits that an insurer is required to return to its New York policy holders as follows. They look at profits divided by average countrywide earned premium to net worth ratio of the 6-year period. And so they're looking at that profit as a percentage of premium. And then they multiply that by the 6-year total direct earned premium for New York motor vehicle insurance. And then within 90 days of notice, an insurer must allocate the note among its New York insureds of record. Next slide. And in South Carolina, South Carolina's law, and I'll need Katie Callahan from my team to keep me honest, but this their law goes a little broader than just private passenger auto. They do look at property or casualty insurance. It gives their regulator authority to require insurers to report loss and expense experience to determine whether rates are excessive, and submit a supplement to their annual statement. If in the preceding 5 years, they show an aggregate operating profit in excess of a reasonable amount, then the regulator can order a general reduction in rates to reduce the operating profit to a reasonable amount. Or they can also order a pro rata refund of excessive or unreasonable profits, plus interest. And then those are defined as aggregate operating profits in excess of either 15% of earned premium over a 5-year period or 25% of the average policyholder surplus over a 5-year period. All right, that was a lot. Those are our state examples. There's a variety. Any questions or comments or feedback on any of those? Go ahead, Marceline.
Yeah, thanks so much. This was super helpful. Just a couple questions. When you looked at the different models, were you able to glean anything in terms of implementation or efficacy of these different models in terms of ability to easily use from the commissioner standpoint and in terms of providing any excess profit back to the ratepayers? I just didn't know if you were able to do any sort of comparative analysis of these different models.
Yeah. Katie, I don't want to put you on the spot, but did any of that come up in the research?
No, I could look into that. I don't know how often any of these states actually issue excess profits. I think that's a good question. And then I think we would probably need to touch base with the regulators to get the inside scoop insofar as, the implementation questions.
Thanks, Kitty. Not trying to crave more homework, but I think it would be interesting to see how often this actually was used or how often the excess profits were returned.
Sure, I'll look into that and follow up.
Thank you so much.
Katie. Mike, go ahead.
Well, that was my question is how often a rebate has been issued. I mean, I would tell you from my experience at the sales level that excess profits are typically returned in the free market. If a company gets its loss ratio under control or they're making more money, they either reduce rates or they do reduce rates and are more aggressive in pursuing additional lines of business. So while people aren't handed a check directly, I think the market regulates this to some extent. And I think that was sort of verified by the overall loss ratio at or near 100%.
Thanks, Mike.
Uh,
Go ahead, Nancy.
And I'm representing the insurance interest, but one of the tools we use is to see is how competitive a marketplace is. You obviously, Commissioner, are aware of the Herfindahl-Hirschman Index, which is indicative of whether a market is competitive. Maryland is considered a very competitive market, and Lynn, on one of her slides, showed that the number of auto writers in the state is a good number. I think it was 147 on her slide. And as Mike said, insurance premiums are always trailing indicators of the marketplace. So, we took aggressive premium increases to offset the bad losses of 21, 22, 23. And now 2024, now we're seeing that they did make a profit. And I think in one of your previous presentations, Commissioner, you were saying that the premium levels you were starting to see decreases in the marketplace.
Yep.
And I think that's a big indicator because we're so competitive, the market responds to when they're making a profit, they'll say, yeah, now we can be more aggressive in our pricing to gain larger market shares. And when you look over that 10-year period, you don't see an excess profit being obtained by the private passenger auto market. You have that COVID thing, and someone reminded me, there were some rebates during that COVID time, but I don't have that information handy. But I remember there were rebates sent out to policyholders during that period.
Yeah, Nancy, just one little correction maybe, or maybe we're just saying the things two different ways. I think we are actually moderately concentrated in Maryland in the
Commission-
auto market. Yeah.
Yeah, Commissioner, that's just what I was going to say is that we've also looked at the HH index, and Maryland is the 7th most concentrated market in the country. So there are like 40 some odd states that are more competitive than Maryland, actually. And that's a couple years old, but I was talking to folks earlier today to get that data. So again, I think the data I'm using is a couple years old, maybe 23. But again, we are pretty concentrated. We're not very competitive compared to some other states like California, which is the 2nd most competitive market in the country.
Yeah, and we can get some more information to narrow it down, because I would say I hadn't seen the 7th most concentrated for private passenger auto, but yeah, moderately concentrated doesn't to me mean non-competitive, but just it and we do have a number of carriers that participate, but just yeah, there are some heavy hitters that have a lot of market share. Go ahead, Mike.
I get definition of concentrated. I assume that means that the bulk of the business is written by a small number of companies.
I think so. Yep.
Well, I would just add that probably 3 or 4 at different varying times, most of those companies are aggressively pursuing new business. It ebbs and flows. And well, I'll just leave it at that.
Yeah, absolutely. Any other thoughts there?
And just one other thing, just that as the law is written, is that premiums cannot be excessive, inadequate, or unfairly discriminatory. So as you're reviewing our rates, obviously your actuarial staff is looking to make sure that those premiums rate increases are not excessive, so that they fall in line with what the losses are, and that you know you're making changes. What the ask is for by insurance companies and what they actually receive in a rate increase are obviously different than what happens in the marketplace. So
Yeah, I will say in Maryland, we are file and use. But I will also say that, and I think we've said in earlier meetings, that the vast majority of carriers wait for approval before releasing into the market. Not universally, but most of the time. And yeah, Aaron and his team do, they ask some tough questions. Any other questions about this presentation or things? So we can get some more information about that market, the Herfindahl Hirschman index for this team. And any other things that would, and of course, like maybe some effectiveness or utilization, I would say. We can see if we can get utilization data about those state excess profit laws. Anything else we should be taking back for homework for our team? Okay. Senator Guile, welcome. We're glad to have you. Okay. Let's go ahead and go to the next part of the agenda. We sent out as materials a discussion guide. And Craig, I don't know if you wanna pull this up, just so folks can follow along, or if we just wanna.
Yes, I can do that.
Okay, great. So I think for our team, we wanted to start having a discussion today about each of the topics we've covered and then some of the options that were presented. I will, if you see an option on here, you should not assume that it is something that MIA wants to pursue. I think this is literally just a catalog. We want to get the discussion going. I think there's something about graduated licensing updates in there. I need my son to drive at age 16. We'll have a conversation about all of that. But so can you scroll up a little bit, Craig? Oh, so sorry, go down a little bit. These are some of the evaluation criteria generally that our team found, just things to think about as we think about policy options, relevance and effectiveness, efficiency from a cost benefit analysis standpoint, equity, if the policy is fair and just, feasibility, whether that be from a political, administrative, or technical standpoint, impact, what the broad long-term effects of a policy on Maryland consumers and our market might be, legality and constitutionality, social acceptability. Those are just, again, not general thoughts about what evaluation criteria could be. Okay, so can you scroll down a little bit, Craig? Okay, topic 1 of our charge in House Bill 1098 is ways in which the term affordability has been or may be defined in the context of the establishment of private passenger insurance premium rates. And so we identified 2 possible definitions of affordability. The first one was from FIO. The second one was from the Insurance Research Council. So the first one from FIO applies a premium to income ratio to gauge whether the average cost of mandated liability insurance is affordable for persons living in affected zip codes. And the zip code is defined as one with a minority population or with a median family income that's less than 80% of the median family income for the relevant metropolitan statistical area. And they look at the voluntary market. So my understanding is they don't look at any residual mechanisms. So their 2017 study presumes that a private passenger auto affordability liability insurance is unaffordable for persons residing in an affected zip code with an affordability index ratio greater than 2%. IRC measures affordability based on the average cost of insurance for all consumers in a state relative to statewide median income. So it doesn't do that zip code dive. It looks at a statewide measure. And then to arrive at the average expenditure in a state, it divides the total written premiums on both the voluntary and residual market by the number of cars insured under liability coverage for a full year. So unlike FIO, the IRC does not consider only written premium for required coverage. They also look at optional coverages, which most people actually carry, including collision and comprehensive. And so they describe their affordability index as a tool to measure and compare auto insurance affordability over time and across jurisdictions rather than a means of establishing a threshold for affordable insurance. So we had a couple of questions here just to provoke some thought, but I guess the first question is, what do we think about these definitions? Does either of them capture an appropriate look at affordability? I guess that's the first question. And does either of them leave anything out?
Marie, can I just go back when you were talking about the review and the thresholds and stuff?
Yeah,
One question that came up with the insurance industry, and we weren't sure, is that it talks about consensus. And we didn't know what is consensus for this work group because we've never really talked about what consensus is. So is that everyone, some, I want to get a baseline to understand before we start discussing all the different questions.
yeah. So I think our thought, and I want to capture, so first of all, thank you, Nancy. That's a great question. I do want to see what folks think about how we want to handle the report, but my initial thought is that when we talk about consensus, it's everyone. And then if there are options that one person or a group of folks feel strongly about and then others feel strongly against, then in our report that we are outlining both for and against. So my hope is to not take a vote and not say, we recommend this because we've adopted this 4-2. My hope is to have a discussion, talk about where there's agreement and consensus, and to the extent that we don't agree, talk about why and the considerations. Sarah, go ahead. I thought I saw her come off mute. Sorry about that. Does anyone have any reactions to that format? Marceline looks like she's thinking.
Come on, do it. Come on, get yourself out there.
All right, I'm here. No, I think I had the same questions Nancy did, and I think striving for consensus is great and makes a lot of sense. And I think it will be up to the commissioner if we end up with a 2-1, 3-1 on every question on how we proceed. But I'm hoping that we can find places where there's broad agreement.
Was that Chair Vital's voice, or am I making that up?
I'm sorry, I'm in the car. I didn't mean to talk.
We're so glad you're here. Thanks for joining.
You're welcome. I'm driving, just listening. Thank you.
Great. Well, we welcome your input along the way for sure. All right. So I think let's keep that then as our sense of how we're going to work through going forward. And to Marceline's point, if folks have different opinions along the way, we can talk through. But I think my hope, and I think we're all is that we can handle things in that manner. So to go back to an affordability index, how do we measure what's affordable in Maryland? Any thoughts or any further information that we might want on this topic?
Commissioner, when this word affordability first sort of being discussed, we understood it to be a term that has been used by the Maryland Auto Insurance Fund and has been a point of discussion between the MIA and the Maryland Auto Insurance Fund. And there's really not been a thing that is something that's used in the competitive marketplace. So I guess our question is, once you come up with, or if you have these different things, how does that apply or is it going to be used in the competitive marketplace? Because we understand the term was to try and define that term for Maryland Auto Insurance Fund's use that they had used prior to this, or how they're going to move forward in their rating. So I guess that's the question for the private passenger marketplace, the competitive marketplace is, how does that going to be applied then to our market, where we initially thought that this had been a term that had been discussed between MAIF and MIA?
So I think, so there's a couple of different places in which we're gonna talk about affordability that are outlined in the statute, right? So I think I wanna read, I got the bill up, wanna read it. It says, we shall establish a work group to study the affordability of private passenger, like number one, the affordability of private passenger automobile insurance in the state, including factors that contribute to premium rate increases and trends in rate increases. And so as I read that and the MIA reads that, this is a trend analysis. This is looking
Okay.
at the affordability of our overall market. This is not using this measure in rate making. This is just looking at trends, what is happening in our market, how is it impacting Maryland consumers? Understand that that our auto insurers rate on risk, right? But this is really about how do we understand how those premiums are impacting Maryland consumers and the required insurance that they have to buy. Go ahead, Mike.
Well, based on what you read, I think if we were going to define affordability, it should include the drivers of the cost of insurance, labor, materials, and profit. You can't address affordability without addressing the what drives the cost.
Yeah, absolutely. Absolutely. And I think we should probably add that in. Go ahead, Marceline.
Yeah. First of all, apologies. I mentioned to the commissioner my Xfinity I have cut out today, and it won't be restored now till 11:30 p.m. So I may be in and out. I may end up on my phone. But in terms of the affordability, given kind of the mandate of the work group and some of the rubric, I like the FIO definition because it addresses, it looks at low and moderate income households, and it looks at it whether or not sort of addresses the idea of a disparate impact. And if we're looking at why we have high rates of drivers who are driving without insurance and we want to look at affordability, I think that's the kind of pool of drivers that we want to be focused on, because that's the pool that is most likely not getting insurance because of affordability measures. So, and the FIO definition is, you know, kind of a government definition done by economists. So I also feel like it's pretty objective as well in terms of the populations we're looking at and trying to grapple with around affordability issues.
Thanks, Marceline. Any reactions to that? So far I've heard we like the FIO definition better. We need to outline the trends and contributors to what's driving the cost of premiums. Any other initial thoughts? And to be clear, this is nothing is set in stone here. This is a discussion, so our team can put things on paper that people can react to. So. Okay. So I think then as we, what then we will start to write up, and again, nothing set in stone, is a preference for, or that we thought the FIO definition was appropriate, that underlying trends and costs should be considered, and an emphasis, I think, Nancy, that this is in the context of looking at overall affordability of the market, not for use in rate making.
Yeah, as long as that's clear, that we'd like to make sure that that's in there. So thank you.
Okay. Great. Look at us agreeing. That's fantastic. Okay, so let's scroll down to topic number 2, and I think we talked about the affordability, including factors that contribute. And here's where we get a little more into the factors too, right? We're going to put a lot of factual information that we previously considered in the report. I think, and I think back in our first meeting. And so this is really, I think, just describing some of the trends that we're seeing. And again, those factual things that we discussed. But I did want to highlight a couple of things or a couple of questions from our team. First, in response to an inquiry, the MVA confirmed that the Department of Public Safety and Correctional Services, or DPSCS, does not currently have access to the MVA's online insurance verification program. And so that they explained that that system, which is used by police officers during traffic stops, would have to be modified in order to sync with the MVA's online insurance verification program. So I guess our first question is, do we want to highlight as a potential area of further study whether modification to the relevant system should be implemented to enable officers to identify instances where we might have an uninsured driver?
I'm going to speak to that right away. And I know Al was just as surprised as I was. We had thought when the online verification system legislation went through, was it in 2024, Al? We had assumed that the online verification system included the police officers as well. I think we were taken aback by surprise. And when we did reach out to the Motor Vehicle Administration, they said, well, we don't amend that part of the code. That needs to be done by a different, the police, the state police. So I think we were surprised, and we would love to pursue that the officers would be able to verify if someone is driving uninsured. So yes, further legislation would be great. Thank you.
Thanks, Nancy. Go ahead, Al.
Yeah, I really don't care whether this is in the report or not, but I initiated a meeting with the MIA and the MBA about a year and a half ago, maybe longer, to see if we could get an accurate guess on what the rate of uninsured drivers is in close to real time. That didn't go anywhere, and obviously I know with staffing issues now that it's not going to be a high priority. But the MVA can tell us how many registered vehicles we have. The MIA gets reports every year on how many insured vehicles there are. And I would think if we could develop some kind of a protocol so that we can find out the number of uninsured drivers in a reasonable amount of time, that would be helpful. We get these national numbers from, Nancy, what's the name of the group?
Insurance Research Council.
Yeah, we get something from them every year. And when I mentioned it to the MVA, their guess on uninsured drivers is like half of what this national organization reports. So if, again, I don't care whether it's, in this report or not, but, I just happen to recall that if, we can at least put it on the to-do list, that might be helpful. Thank you.
Absolutely. Thanks, Al. Marceline, go ahead.
Well, I agree with Al that having good, accurate data would be great. So I support that. I guess my question is twofold. One, in terms of political feasibility, what the cost would be to get this going, because obviously this year, we all know it's going to be a tough budget year. And so I wonder if we had a sense of what that would look like, because that would affect whether or not legislation would be easy to move or not easy to move. And secondly, for me, it feels a little ancillary to the discussion of around affordability, because I don't think I don't think our rate of uninsured drivers, whether accurate or not, has been like ticking up a little bit, and I don't think it's somewhat sticky. So I'm not sure um, if the penalties. I think the penalties have had maybe the effect that they could, and I'm sort of not surprisingly more excited about looking at ways to bring the costs down for low and moderate income households. So I'm not opposed to it, but it's not necessarily germane to this report to me.
Thanks, Marceline. So maybe, and I just want to clarify too, and this is, I hate to put Katie on the spot, but I'm going to in a second. So what the MVA's work does do is it gets insurance information more quickly and the ability to suspend registrations, and the suspense of registration at some point, I think, makes it into a DPS-CS system, but perhaps not the insurance verification. So I think there may be an ability to get the information, but there is a lag.
Yeah,
Katie?
I think what, for example, Nancy was saying the industry was hoping would happen. That's not what's happening. Like
Yeah.
the police officer pulling someone over, they can't confidently, just pull up a database and be like, oh yeah, this person's driving uninsured and do something about it. So, but yeah, to your point, Marie, this is the MVA in their recent JCR report that they submitted. They indicated that the numbers are showing that these new systems, what they call the OLV program and the Book of Business weekly reporting, that it's greatly enhancing their ability to like quickly move through these cases and take the appropriate action. I'm not exactly sure what the communication mechanism is past that, but to your point, I think that once a case is closed, I think that determination is probably accessible to the officers. But I mean, I don't want to misspeak. I probably have to talk to them about how that bit of the information is relayed.
Okay.
Yeah,
Well,
I think that
go
because
ahead.
now insureds just show them an insurance card to show that they have insurance in place. And so therefore, the officer may be looking at something that's not true at that point in time. So instead of being able to say this car needs to be removed from the road, it's not insured, they can't do that because it's not real-time information. So, and I think, having someone that's driving uninsured on the roads actually is an impact on all of our rates, because if they're in an accident, then we're making claims under our uninsured motorist coverage and underinsured motorist coverage when a claim occurs.
Well, I think what we can do with this one is I think write up a little bit about the data and access to data, and just give to folks to react to, because I hear you. I hear what you're saying, Marceline, and I appreciate your comments. So, okay, and then the next item, the work group did consider the results of an Insurance Institute for Highway Safety Loss Data Institute study that looked at the effects of various graduated driver licensing laws on the frequency of collision claims and fatal crashes involving licensed and insured teenage drivers. And so the question was, do we want to highlight as a potential area of further study whether changes should be made to relevant graduated driver licensing laws in Maryland with other agencies? Because we are definitely not the experts in this area, but I think there was some pretty profound data shared as part of that look.
I think if we're looking for ways to maybe lower the incidence of teenage accidents, that this would be something to look into for further study, compare it to other states, and also see if, maybe, more practice hours driving may assist. So it's just to get that losses for teenagers less, that would have an impact on rates overall. So I think that's important. So, I mean, I think that's just something for further study. I'm not saying that we need to make that change. So,
Okay, go ahead, Marceline.
I guess a corollary to that, I know like 30% of folks in Baltimore City don't have cars, and it's very difficult for some families to get their teens the hours needed already. So I'm not opposing it. I guess I'd say if we were going to look at this, I'd also want to look at things like requiring driver's ed at school again, or something like that, as opposed to just adding hours, which puts the onus on families, looking at other ways of achieving that. So I'm supportive of of looking at it, but I would broaden it to look at not just hours on the road, but like, could it be required again? Or, are there ways that it's not only on the individual family to figure out a way to do this?
Got it. Got it. Okay. I think we can write something up along those lines that marries those two perspectives for folks to react to. Any other thoughts on that? Okay. Let's continue scrolling. So topic 3 that we're charged with studying is policy options to provide greater transparency regarding auto insurance premiums and to increase the affordability of auto insurance in the state. And so we discussed the fact that relative to other states, we do have a high percentage of insurance claims with litigation, which can lead to higher litigation costs for insurers. Is there, and I think we want to ask the question, my gut here is that this, but we should talk about it because I know this is something we talked a lot about is there litigation reform that the work group wants to recommend, or should we really merely include a factual discussion of recent changes in law and legislative initiatives relating to this issue? We went from an easier question and topic to a harder one.
Well, I think you need to note that we passed enhanced uninsured motorist benefits a few years ago. That does not decrease the cost of insurance. I know that they will pursue the eliminating the cap on non-economic damages again this year. That comes up every year. To be perfectly honest with you, we have a legislature that is pretty sympathetic to the trial bar, and I don't think you're going to get. I don't think there'll be a lot of appetite. Maybe we can put a quash on the non-economic damages for a few more years, but there's probably just not a lot of appetite for tort reform in this particular state.
Thanks, Mike. Go ahead, Al.
Yeah, I agree with Mike. I think it's good to mention it so you can point to it when other issues pop up. But I don't know that anybody should be investing the capital in an election year to fight that kind of fight. But that's not my fight. I'll defer to everybody else. But that's just my own personal opinion.
Go ahead, Nancy.
Oops, I'm trying to lower my hand. Sorry. Just today, I provided you an overview of 2 recent tort reform states. Obviously, as we talk about the political reality of Maryland, Marceline and I sometimes sit on the table together. So I just want to say we fought raising the minimum limits on bills, but some of the things that are in those 2 tort reforms states, we saw immediate impact in Florida, where we had a bunch of carriers entering the state. And just recently, you'll see that there was rate decreases of 10 to 6% in the personal auto A lot of the new carriers entering the market, I think that I said 17, which I thought 2 were auto. There were actually 4 that were auto that entered the market because of the tort reform. What's a little bit different in Georgia and Florida is that Florida changed their statute of limitations from 3 to 2 years. Georgia was already 2 years, but that kind of impact obviously would have an impact on our rates. Whether that would be feasible, I don't know, but narrowing the window to file suits would obviously help. Another thing is about phantom damages. It would be that medical expenses already paid would be calculated based on what the health insurers really paid versus what the cost of the medical bill without already being discounted. So those are just 2 ideas which can be used to supplement the report. I know the feasibility, we're already going to be fighting removal of the non-economic damage cap because we saw that in our report from 2 years ago, we saw that private passenger auto impact would be 19%, and I think commercial auto was somewhere around 30%, which would have a big impact on affordability for the consumer in the marketplace.
Any other folks want to weigh in here? So I think if I were, and I just want to summarize this discussion, then we're not talking about recommending litigation reform, but what we are talking about is maybe a factual description of some recent laws and their impact on premiums in the market to the extent we can measure that. Okay. Here's another easy topic. So we looked at alternatives to Maryland's competitive rating file and use system. So I think we are not on the scale of how states review private passenger auto rates. I would say we are in the more laissez-faire range, not the most, but more. And we looked at a number of other states that maybe take a little bit of a closer look, maybe have a longer required review period, maybe have prior approval, maybe over a certain percentage of increase. So I think our question for the work group is, do we want to offer a recommendation that we like what we have, or do we want to further explore whether there are higher standards of review needed? Go ahead, Marceline.
I would love to see us make a recommendation about supporting prior approval. I do think some other states, as your presentation showed last time, have been moving towards that. Certainly, if there's not consensus around that, I think having a longer timeline to review and looking at something like the Massachusetts law has, which explicitly allows the commissioner to basically disapprove rates that are unfair or inconsistent with sound public policy, which I think is sort of implicit now, but I think just making it explicit gives it a little bit stronger power as well. So I know I've talked to colleagues in DC where they shifted and they thought it was helpful in terms of having a more robust discussion and kind of a deeper look at some of the issues. But I certainly think moving to something less laissez-faire with prior approval being one option is something I'd support.
Yancy, go ahead.
Okay, thanks. I might speak up on this. I thought the question here is talking about affordability. So does that changing to prior approval do anything to lower rates in the state? And the answer is no, it's not. The amount of time for review is we're trying to get speed to the market to make our rates reflective and competitive to what's happening now. So we want to make sure, excuse me one second. thought I had everything on silence. I apologize. The question is, we're trying to get our rate requests to the marketplace as quickly as possible to reflect what's in the marketplace. So whether that is, rate increases that are taking a long time to be reviewed, so therefore we can't implement them timely, or whether or not we want to take rate decreases and be able to implement them timely. The question is, how does a prior approval do anything to change affordability of the marketplace? And there's nothing out there that says it does. I did look at the material that the commissioner provided in her overview, and of all the 4 things that were listed, it was only DC, a very small marketplace. We're talking about one city that has moved to prior approval. You're not seeing that in the rest of the country. So I would say stick with the current system as it is currently. We know that there is a backlog currently with the MIA due to staffing shortages from last year, and they're working hard to catch up to get the speed to market quicker. But I don't see that there's any necessity to make any changes to the current marketplace.
I'd say the only thing I'd say with that is that in the states, DC, and some of the other states that have prior approval, is that it does require insurers to disclose and justify their claim cost and their administrative expenses, including executive compensation, at least in some places like California. And it gives the commissioner an explicit ability to disapprove rates. And I think having a little bit more timeline from folks that I've spoken to has been helpful. So again, I'd love to see us moving in the trend, as some other states have, to a little bit less laissez-faire and a little bit more empowering the commissioner to review and do the timely kind of oversight that's needed.
I would just add that I agree with Nancy. I would reiterate that we have an available and competitive market, and that I don't think, I think the reality, the commissioner has said that the reality is most people file and wait for approval. And I don't think that rate regulation is going to help make, it is not one of the drivers of what's making insurance unaffordable.
Anyone else want to be heard on this one? So I think I fully expect not to get to consensus on this one. I think what Al is smiling. So I think what we'll do here is write up a little bit of the split of pros and cons and changes and the things that we've discussed. We'll probably add into that a little bit more for our next meeting on whether there are things specifically that our team identifies that would be helpful. But we'll have a discussion about that too. But yes, I don't think we're no votes on this one. I think we'll have a split in pro and con here. Okay. So the next item we want to talk through is Marceline's presentation to the work group on October 28th, reference laws enacted in at least 2 other states that limit expense loading by prohibiting insurers from considering certain expenses in rate making. And I think, Marceline, you were just talking about these a little earlier. Such as political contributions and lobbying, executive compensation over a certain amount, bad faith judgments and associated defense and cost containment expenses, costs attendant to the unsuccessful defense of discrimination claims, fines and penalties, institutional advertising expenses, and payments to affiliates for goods or services in excess of the fair market value of those goods and services. And the question here is, do we want to make a recommendation about legislation to prohibit insurers from considering any of these expenses in rate making? Go ahead, Al.
What states have enacted this?
California has, I believe Massachusetts, and in various forms, a couple states have.
Right,
Yeah,
thank
I
you.
was trying to find a little more details in your presentation, and it was just, I didn't think there was enough information. And I don't, not to say anything, but I don't think California is having such issues right now in their insurance marketplace that this would be something that we would want to adopt the California model when they're having such difficulties in getting insurance companies to stay in the marketplace.
Sure. I mean,
Claire-
I'm
go
I'm
ahead.
happy to, oh, go ahead. Go ahead, Commissioner.
I just had a clarifying question for Nancy. When you say California is having a hard time, are they with private passenger auto as well as home?
Well, they put a hold on any rate increases for 2 years, which has made a little bit difficulty in even turning a profit in the state. There were some companies that were discussing not writing any business at that time. So it did have an impact on the rates. So I just, I know that this was something that was mentioned, but, just getting this information packet on Thursday afternoon and trying to go through and find information for each one of these discussion points, there just wasn't enough information even provided about this concept. And yet here it is as one of the recommended questions to add into the discussion. So for me, this is a non-discussion point. I think that what we currently do in the majority of states and makes consistency across all the states and lets us be able to file on a national level and be consistent across the states, which helps with contain costs for different insurers.
So I think I'm happy to try to provide more information for further discussion. That's not a problem at all. I do think if we're looking at affordability and we're looking at how to bring down rates in Maryland, this is certainly something that is worthy of discussion and worthy of really looking at pretty seriously. In the states that have done it, it saved consumers millions of dollars. And so I think, from a political feasibility standpoint and from a equity standpoint, we know that affordability is a critical issue right now and that people are really struggling with cost of living increases. And while we saw that executive compensation for insurance companies increased 27% between 2023 and 2024, and auto insurance rates increased concomitantly among a lot of those providers. I do think looking at things like um, these kinds of disallowing certain kinds of cost is very similar to something the legislature passed last year with energy companies basically saying that why should ratepayers have to pay for insurance companies' political lobbying? Why should ratepayers have to pay for excess executive compensation? Why should all of that be passed on to ratepayers? Why should advertising that's not, you know, to procure new buyers be passed on to ratepayers? And I think that is a real important equity and affordability consideration. I'm happy to get more information about those rules and what the impact has been for further discussion, but I definitely think politically it would be popular, and politically it gets at some of the things that are passed on to consumers they may not have been aware of.
Yeah, I really, Maryland is not California. And as you said, it's just 2 states that you mentioned. And I'm looking at your report and really what you wrote into your PowerPoint really does not go into any details about this, this specific item.
It doesn't, because it was a PowerPoint, but I'm happy to get you more information
Yeah,
about it.
I appreciate it, Marceline. I was just saying in preparation for today's discussion, you know, it's hard to investigate every single one of these topics and be prepared. So I just wanted to say that this maybe should be passed on for further consideration.
I would just add, when you look at the executive compensation over an entire book of business, it's a rounding error. It is such a small number, it's a rounding error. And quite frankly, the consumer has 140 some odd choices in this state to purchase auto insurance. I don't, you know, getting into what somebody pays their employees isn't our business.
$5 million increase from Geico, $9 million increase in a year from over to Allstate, more than $1,700,000 increase to farmers, about
a
$1 million
rounding error.
to State Farm, Travelers, and USAA. That's a pretty significant increase in compensation in 1 year.
It's none of our business, and it's a rounding error.
Well, I think it's our business if it's being passed on to consumers.
That's the cost of doing. That's the cost of doing business. It's an input.
Well, I think consumers might disagree, and in other states they've said, in fact, that they don't want that all of that to be passed on to consumers. Your political lobbying expenses should not be passed on to consumers. Some consumers may believe. Some legislators may agree too.
So
Why? That's the cost of doing business. Your advertising is the cost of doing business. Your political lobbying is the cost of doing business. Your fees for organizations and trade associations are the cost of doing business. So those should be assumed by the company, not passed on to ratepayers, to drivers.
Well, where does the company get that from?
Okay, so I think we're gonna, this is one where we're not gonna have agreement, and that's totally fine. I think is in terms of next steps, why don't we get a little more information, some of the exact state laws we can share with the groups. I think we'll write up a lack of consensus here and move on. I think and Nancy, I hear you. You're doing great. But you know, I also just want to emphasize we are really just discussing at this point. I think we're our team is trying to get some initial feedback and feelings and temperature taking so that we can further refine a draft for you all to consider. Okay. All right, so credit, we're not gonna have consensus here. I can just see it right now, unless Nancy's changed in like the past. Yeah. So if we can go back up to credit though, sorry, because we do need to talk about it. Keep scrolling down, Craig. There you go. There you go. A little further up. There you go. Okay, perfect. So we talked about there are laws in several other states that restrict or prohibit the use of certain non-driving rating factors. In Maryland, we prohibit credit on renewal, but we allow it as an initial rate factor within certain parameters. I think folks have pointed out this was a hard-fought discussion, but there are states that have gone further, I think, since Maryland's law and just prohibited it on initial rating entirely. So I guess, again, that's the first question. I don't anticipate consensus here, but I think I'm gonna pause and see if folks want to comment, but I will just let me frame it up as I think this is one where we are writing about pros and cons. So let me see if anyone wants to weigh in. Go ahead, Nancy.
Well, I just, because of the fact that credit is such a difficult issue, and I know that when we were first talking about medical debt, it's not used in Maryland. We know there was a law passed last year that Marceline worked on, and the NCOIL model does not include medical debt. So just for further reference, but there really hasn't been a lot of movement on banning credit in the states, except for in Washington State. Um, the the insurance department had put in a bill to ban the use of credit, which failed, which afterwards the commissioner, by regulation, banned the use of credit, and it had an immediate impact on the marketplace. What you saw was that obviously they said about 60% of the population saw a rate increase. And it was mostly impactful on senior citizens. That was where you saw a big impact. What had happened during the ban, then a lot of the insurance options for consumers became more limited as insurance companies felt that this very predictive factor was no longer available. And so you saw limitations on underwriting, tighter acceptability. And then at the same time, those people that were seeing those huge rate increases then were shopping for better rates. Well, now the rates had now become volatile because credit was no longer there as a factor. And when they began switching carriers, if they've been with them for a long time, they may have lost their loyalty discounts and accident forgiveness, which in the end, especially the senior citizens, saw really rate disruption in the marketplace. Obviously, that was reversed, but that really is the only example of a state that that banned the use of credit and then went back and withdrew that ban. So I just wanted to let the group know about what the impacts we're seeing in the marketplace due to that ban on credit. So obviously, anytime you ban a factor, there's going to be winners and losers in the marketplace. But for us, credit is a predictive of loss. So for us, the drivers that are less likely to have accidents are the ones that were being surcharged. So enough said, and I know Marceline and I are going to disagree, but I just wanted to know that I provided that information today for your use. Thank you.
Go ahead, Marceline.
Sure, thanks. I will be brief. I'm happy to share information, both studies that we've looked at and studies that we've done with others and that have been looked at nationally about the impact of credit, especially as a racial justice issue and an equity issue, which is one of the rubric pieces that we're looking at today when we're evaluating options and the disparate impact it's had. I will say Washington State is one state, as has been mentioned, so that certainly hasn't been the experience in the other states that prohibit the use of credit. And so, again, I think we can agree to disagree, but I'm happy to share more materials for folks to digest and also more information about the other states that passed laws banning the use of credit and did it by regulation and what those impacts have been there.
Great, thanks. Yeah, I think Marceline, that would be great. More information on the impacts. And Nancy, you said you sent some around today. I'm a little behind in my email, but yeah. Okay, so we'll make sure folks have access to that. The next question, also not anticipating consensus here, but maybe, I don't know. Any recommendations about establishing new requirements for or restrictions on territorial rating? And I'm trying to get up the presentation right now, but we did hear about a handful of states that have some requirements for how territories are designed. For example, looking at bigger than zip code and some factors there. to help to potentially reduce inequities. Go ahead, Nancy.
We've had several bills over the years addressing territory in Maryland. The latest bill, I think, was in 2023, trying to separate Maryland into 5 territories. What I did was just provide information about what happens when you try to refocus territory across different areas. In the end, the people that are living in the territories where less accidents occur are going to see an increase in rates, and those people living in areas where more accidents occur will see a decrease in rates. So, it's more of the urban areas is where, obviously denser population, more traffic, more on-street parking. These type of things tend to have an impact on losses. And so therefore, if you start adjusting territory, the winners will be those probably in certain urban areas, and the losers will be everyone else in the state. So, it's how you want to pick and choose who wins and who loses overall. That's what my submission was that I sent out today.
Yeah, I agree with Nancy on credit and territory. It does nothing. It definitely, it just switches who pays. We've already concluded that it's basically a dollar in, a dollar out, and the elimination of credit or territorial rating just pushes the balloon in a different direction. So whether you eliminate it or not, you still haven't, if you did eliminate it, we still haven't addressed the affordability issue. Affordability is driven by a lot of other things.
Well, I would say affordability is also driven by the rating factors of zip codes, and we have very good data to show that and to show the disparate impact that the more concentrated a community is with Black and brown residents, the higher the cost of insurance that those residents pay per zip code. And I think, again, we're talking about equity issues, we're talking about affordability issues. And I think in some ways, at least in a place like Baltimore City, you're actually talking about right sizing the cost that people pay because you're looking at accidents in certain zip codes. But if you think about a place like Baltimore, we have thousands of commuters coming in from Baltimore County and from other places every day to work downtown and to work in some of our major hubs, including our hospitals, our eds and meds. And those drivers, when they get into an accident, they get into an accident coming off of 83. They get an accident coming off the highway. Their home is not rated where they live, but the place where they come off of the highway is the one that's rated. And I think that is problematic because the driver goes home and parks their car in a different jurisdiction, but the community where they took the off ramp is the one that suffers the consequences and the price of that accident rating. So I think it is right sizing it to some degree. There's different ways to talk about it, but again, I think if we're talking about equity issues and we're talking about affordability, that is one way to squarely hit both of those.
Well, the consumer does pay more for a longer commute. So that is addressed in some small way. So
in a very small way comparatively.
Okay.
Yeah.
Well,
let me give you an example, because I drive about 6 miles from 21228 into the city every day. And so I'm a county resident. I get into an accident. That risk is going to hit my personal, right? Certainly, but the actual risk of the geographic area, the accident I get into is not going to hit where I live. It's going to hit the zip code where I'm driving, right?
No, it's gonna hit, it's gonna hit, my understanding would be it would go against your if you're at fault, it's at your policy and in your house.
So
Yeah, I'm
it'll
not-
go against my policy for my individual level risk, but in terms of the general factor of how we're
Correct.
measuring the risk of a territory, it's
Correct,
not gonna
that's
go to where I live.
Correct, yes.
Yeah, and I think that's what we're talking about. I think, Nancy, I'm not talking about, and I don't think any of the state examples we gave were 5 territories across the state of Maryland. I think they were talking about larger territories or factors of territories. Or in the
Yes,
case
that's
of
correct. I was
Connecticut.
just referencing the prior legislation that we've seen over the years. And I think that's also true. I mean, I live in the city and I commute down to Annapolis. So it's just another example. You know, just because the population of Baltimore is what it is, it doesn't mean that Baltimore City residents don't also commute outside of the city and have accidents elsewhere. So it can work both ways.
Yeah. So I think one way, so one of the laws we looked at was Connecticut, actually has changes in territorial classification subject to prior approval, but it also has a weight for individual zip code or territory and then statewide, a weight for statewide to try to mix it. So again, I hear you, Mike, it's a balloon. There's a risk. We're talking about who pays for it, but I think, and we're not going to come to agreement here, but I think what I'm particularly interested in is understanding if we want to accurately measure risk, are we accurately measuring risk right now? I think that's a question we need to wrestle with a little bit. I'll do that in the write-up. So we don't need to have a conclusion today on that.
Well, at some point, I don't know that we're there yet, but the technology in these cars, at some point, you might be able to pinpoint lost data and more accurately figure that out. Somebody's probably got that data. I don't know if it's
Maybe
readily
Tesla's
available.
got it. I think that's the hope. I think that's
Yeah, and
the
I'm
hope.
not too sure what the data is that you're asking for. I mean, studies have shown that most people have an accident within 5 miles of their home. So it would seem that it's pretty accurate in assuming that within a 5-mile radius, you're more likely to have your accident. So obviously someone living out in Somerset County is going to have less options. I mean, less likelihood of having an accident within their county if they're driving within that county.
Go ahead, Al.
I have tried to maintain my composure, but I'm not. So as I have spoken to legislators over the last 5 years regarding the topic of affordability, my cynical oversimplification is that we have way too many legislators that live in suburban or rural areas that, quite frankly, could not care less about affordability because it's not being paid for by their constituents. And I think that maybe even having a conversation about territorial rating may at least increase the likelihood that some of these folks that currently don't care might be willing to learn more about the issue and become engaged in the solution.
Thanks, Al. Any other comments here? Okay. Al, you have your hand up, but is that a legacy hand? Gotcha.
Yeah, sorry about that.
No, you're all good. Thank you so much. Thank you for your comments. Okay. So again, we'll leave that lack of consensus, pros and cons, and I think some of the details. As if folks, we covered a lot of ground, I think, in that conversation. If there is further information that folks want to share, I think that'd be really helpful. The next topic is, and I think our initial sort of floater balloon on this one is we looked at some low cost and no cost insurance programs. There's just a few that we could identify. The Hawaii model, the New Jersey model, and the California model. Each of these programs is administered by the state's assigned risk plan, and for us, that's Maryland Auto. The question is, do we want to recommend further study into how we could feasibly design a low-cost auto program? Go ahead, Marceline.
Yes. Period. No, I think again there has been legislation in the past, and there's been lots of questions from insurance companies about about what this would look like, or generally that they don't think it would work, but we've never actually had a study of what it would look like or what it might look like to implement something like this. And I certainly hope in a work group looking with the mandate to address affordability and equity, that there is a place where we can come to consensus, as opposed to a report where the advocate supports certain things and the insurance companies don't want to make any changes. And so I certainly hope that a further study to really dig in and look at these models is something that everybody could support. And the California model has no cost associated to it, in the sense that there's no state cost. It's not like a subsidy, which I think again in our current political and budget environment is really positive. You know, in California, the rate's $400 per year in Los Angeles, and it's self-sustaining. So there's no taxpayer cost. And so I think there are lots of things to recommend further study into these different models and the pros and cons of implementing different ones.
And I know that Marceline is aware that, you know, looking into any type of low-cost auto program, where we're looking at people that would have certain financial subsidies provided, is really how the I take that
It's not
back.
a subsidy.
I
It's
know
not a
it is,
subsidy in
Marceline. That's
California.
not what I meant. That they look at their income to determine if they qualify for the low-cost program. And we understand that. So I think as part of looking at a low-cost auto program, another idea would to be provide subsidies for any low-cost driver that they could use to shop in the marketplace, so that they wouldn't only be subject to a low-cost auto program, but they could have some sort of insurance subsidy that they could use to shop with all carriers throughout the state. Either way, it would be able to, for them to be able to afford auto insurance, which we always think is a great recommendation. So I just wanted to add that as part of that look at any low-cost program.
Thanks, Nancy. Any other thoughts here? And I think, you know, to some of these points, we thought further study really needed on this one, but an appropriate area for further study. Okay.
Mary, Commissioner, do you think there will be time for the public to even get to talk? I know we're getting towards the end here, and I just wanted to make sure that we still had time, that's all.
Yeah, let me just check where we are quickly. I think I'll tell you what, because I think I have a guess where folks might be on a couple of these topics, including the NOPI topic and the telematics topic. And so I think unless folks have objections, let's collect work group opinions. If you have something you want to make sure is added into the draft that we float, that'd be great. But I think that we can outline those. I do want to talk a little bit about a couple of the Maryland auto recommendations. And then I think we can leave the excess profits discussion. We just heard about that today. And I think we heard some pretty good comments back and forth that, again, we have enough for a write-up. So one of the items, and again, looking a little more specifically at some of the Maryland auto work. One of the questions we had was about recommending action to adjust the length of Maryland auto policy terms from 12 to 6 months, which may help with affordability and returning folks to the standard market sooner. Al, do you want to jump in on this question?
No, I mean, I covered a couple weeks ago, so I mean, if anybody's got any questions, I'm happy to respond. But yeah, it's pretty simple concept, I think.
Yeah, I think so. I mean, it sounds reasonable to me. I think it happens in a lot of the standard market. Okay.
And I just think that, when we make these kind of changes, there should be some kind of, like feedback afterwards to say that what the impact has actually done. So if you move to that, then we should track to say, this is what happens because we did this. I think if that makes sense, Commissioner, that,
Yeah.
to say, okay, yeah, for a 2-year period, let's track its impact on whatever happens. I don't know what the parameters would be, but
I think that makes sense to me. Does it, Al, any issues with that?
No, just with the caveat that, whatever our results are, typically has nothing to do with things that we do or don't do. It's what the standard market takes or doesn't take, but certainly providing, information regarding our results. I mean, we do that all the time. So happy to do that.
thanks, Al, because I mean, we're trying to encourage participation in the voluntary market, and that would be great to see if we do, result in that impact. That would, obviously benefit our interests as well as yours. I know that this will keep people more likely to be insured than being on a 12-month policy with higher down payments and et cetera. So.
Yeah, and just the caveat is, our cancellation rate is somewhere around 60%. So
Sorry.
is about 60%. So a lot of our folks are back in the market or driving uninsured, either one, before 6 months.
Not if we get that legislation with that police officer, Al. Just kidding.
Yeah.
Sorry.
Or affordability.
Yeah, more affordable, right.
Okay. And then I think this next one, and if folks are comfortable, because I think we had as an area for further study Maryland Auto's proposal for legislative action on authorizing an economic relief credit program. And I think that's one way we could think about some sort of low-cost motor program. Like I see them in a similar bucket. Al, what do you think?
Yeah, my only comment is twofold. As I mentioned to you, and I apologize, I couldn't send it to the group, but if there is no other funding mechanism, the default mechanism, I believe, would be the current assessment mechanism that exists. And my only other comment is, we have an order in front of us that requires us to put together a plan to phase out the affordability index by the end of 2027. So my concern is how a study would impact that. And we can have that conversation offline if you'd like.
Yeah, absolutely. We can have it offline and then we can references as a point identified in the report too.
And I
Okay.
appreciate you considering that as part of that low-cost auto, any type of subsidy to a low-cost
Yeah.
driver, however it's applied, whether in a low-cost auto plan to MAFE only or to the whole marketplace. We would appreciate any study that looks at that.
Yep. All right, great. And then, like I said, I think the excess profits discussion, we will sort of do a little more digging as requested, and we'll probably need to discuss that a little bit more next time we meet. Okay, so we're at 3:51. That was a great discussion. Thank you so much. I know Senator Guile has had a little bit of trouble getting off mute. I don't know, Senator Guile, wanted to see if you're able to come off mute there. Oh, now online. Anything you want to add or comment on before we go to public comment, Senator? Oh, she's a guest. Hold on. Can you raise your, oh, you're good. Okay, great. So, okay, so I think we can go ahead and start the public comment portion of our meeting. If folks who are attendees, if you wish to weigh in, raise your hand, and then Craig will move you over to the panelist side. Okay, so I have Gina Rotano first from NIMIC. Oh, hi, sir.
All right, I think that worked. Sorry, I'm a little close on this camera. Just wanted to go ahead and thank everybody. I know we don't have a ton of time today. My name is Gina Rotuno. I'm the Regional Vice President on behalf of the National Association of Mutual Insurance Companies. We represent over 1,300 member companies across the country. First, I just want to ultimately thank the work group for all the good work that y'all are doing today and the discussions. This is not an easy lift whatsoever, and just wanted to appreciate all your time. So important for Maryland drivers and the effort that you're putting in the discussions. I'd like to share NIMIC's perspective on one of the topics discussed. There was so much discussed, and we did include a letter as well as some supplementary materials, but really wanted to touch base on one of the things that was discussed earlier. And we are strongly aligned with APCIA on this regarding strongly opposing any move to restrict or ban the use of credit as a rating factor. The link between credit-based information and the risk of loss has been consistently validated through actuarial studies and regulatory reviews. Credit-based insurance scores are highly predictive of both claim frequency as well as severity. This gives carriers an objective, reliable way to assess risk, which ultimately will benefit the consumers. When insurers can price policies accurately, lower risk drivers aren't subsidizing higher risk drivers, and this means fair pricing, more choices, and a stable market. We greatly urge the work group, to maintain the current framework that allows credit to be used in rating. We are happy to assist in any way necessary or needed, and have provided a letter and other supplementary materials, but happy to answer any questions or provide anything, but didn't want to take up too much time. I know we're running behind a little bit.
Thanks, Gina. Any questions for Gina from the work group? Okay, thank you. Thanks so much for your comments. Anyone else on the attendee side that wanted to be heard? Okay. Any other, Craig, go ahead.
No, I was just going to say I don't see anyone.
Great. Any other comments from work group members?
Commissioner, I know that we skipped over the NOPE and the telematics. So do you want us to send in separate comments on those things, or?
Yeah, that would be great. That would be great if it'd be helpful. I think maybe I shouldn't be cynical about this, but like I said, my guess is that there would not be consensus on either of those issues. And I think we can start to outline what the pros and cons are. But I think if folks want more items that they want us to at least consider in a draft, then please send it in. And I think, Katie, I'm gonna put you on the spot again. I'm sorry. Can you talk a little bit about the timing?
Yeah, sure. So we do have a bit of a tight timeline, especially in light of the holidays coming up. So I would just request that any comments, especially particularly from the work group members, that you would like to have in this just preliminary draft that we're going to discuss on December 4th. The earlier you could get those, the better. So our plan is we're going to have to compile an initial draft of the report before that December 4th meeting and share that with all of you. And then December 4th is going to be our last work group meeting where we can, maybe hash out any differences or, discuss any changes that we think should be made to the work group report. And also we'll be able to discuss any stakeholder feedback. We are accepting comments through November 24th. And on the work group work page, there is information about that. Any of those, I'm sorry, November 25th is the cutoff for comments from the public. So my email address is on the work group page. So anybody from the public can feel free to submit those written comments to me before that date. And again, those will also be considered on December 4th. But the final report needs to be submitted to the governor's legislative office at least 10 business days before January 1st. So we do have a lot of time to do, or a lot of work to do between now and the holidays.
I'm sorry. So the public is November 25th and work group members is?
There's no cutoff for you guys. We're going to discuss
Okay.
the work group report on December 4th, the preliminary report. But what I'm saying is to help us with the drafting process, if you do have substantive materials, particularly if you're planning to submit several pages of data, it would be helpful to submit that earlier rather than later so that we can take a look at that and integrate that into that initial draft report in a meaningful way.
And then will you be sharing things that you receive with us?
Yes, everything's being posted to the website as it comes in, more or less. Unfortunately, I'm not the website guru, so as soon as I get things, I do send those over to our communications teams, and they're pretty prompt about putting that up. So on the website, if you scroll down to the bottom of the web page, and I'll drop the link in the chat for everyone, there's a written feedback submitted to the work group, and that's where we're going to be uploading the comments. So as Gina commented, she just submitted something, but I actually got that after the meeting started, so that isn't on the website yet. But as we get those comments, we're going to post them there. And I'd be happy to maybe send a periodic email to you guys to nudge you to take a look as things are submitted. I don't want to fill your inboxes though.
I just was wondering if you could maybe send something out to the public through your listserv thing to let the public know that the cutoff date is November 25th. Just because with the holidays coming up, a lot of them may, people might be on vacation, the days before Thanksgiving. And if you could get that out to them to remind them that they need to get those comments in ASAP, it's because gosh knows, I don't know about your staff, but you know how that Wednesday before Thanksgiving, it seems like nobody works. So anyway.
Yeah, we can do that. We did I know our communications team did send out a notice to the listserv, but that's a good idea. We can ask them to send out another blast. No harm in that.
Thanks, Katie. Since I've been emailing with you continuously lately, sorry.
All right, any further comments, questions about timeline? Okay, we covered a lot of ground That was intense work today. I greatly appreciate all of you. More to come and quickly. So I actually, I love that we came to consensus around a number of items. So let's try to hold that. And look forward to the next time we get together.
All right. Thank you.
Thank
Thanks,
you.
everyone, and happy
everyone.
Thanksgiving.
Have a good Thanksgiving.
Talk